Good morning.
Good morning. All right, guys, due by 11:58. You guys got 7 minutes. You don't have to hand it in yet, but I want you to breeze through these answers as quickly and efficiently as you can. I'm going to mute myself. You guys got 7 minutes. 3 minutes. 3 minutes. Brandon, what question you on?
3 onto 4.
Okay. It's kind of irritating because every time I look at my screen, it always ends up being Brandon at the top of my list. I'm not sure why that is. I've been staring at Brandon's face for like 8 months and I'm kind of tired. Oh, man. Brandon, Friday, maybe do something different with your hair. Trip me up a little bit.
I'll try.
All right, 2 more minutes, guys. I'm also not interested in all of this, guys, being Googled, right? A lot of this is stuff that we've discussed. We've discussed inflation all year. So you shouldn't need to be Googling any of this. A lot of this should be things that you can just sit there, sit back, have a sip of coffee, contemplate life, and be able to write an opinionated piece, with the exception of number 2. Number 2 involves research. All right, 2 more minutes. Okay, time to rock and roll. Bang, bang, let's go. So first and foremost, the market is down today due to inflation worries. During New Apps' class, it was getting crushed. It is still down pretty damn bad. Definitely not as bad as it was, but still getting crushed this morning with a slight bounce into the afternoon, but still down very bad if you've been watching or just pulled up your screen. Everything is red with the exception of PayPal. I actually bought some more PayPal, some Amazon, and some Visa today, this morning, right when the market opened during New Apps' class. Before we get into that, because I do want to hear from you guys on inflation and stocks, but first I want to know, why is the market down? So in reality, inflation means what? Can somebody tell me, Jeffrey Kui, what is, and Jeffrey, am I pronouncing the last name right? I apologize.
Yeah.
Yes? Okay, great. Jeffrey, why is the market down due to inflation? But before we get to that, what is inflation?
Inflation is
Don't look at Google. And it's very simple. Inflation is when what happens?
prices are going up.
That's it. It's very simple. Prices going up. Don't overcomplicate things. The people on TV, they overcomplicate things to sound extra smart. It's not complicated. Prices going up equals inflation. You can define almost everything with less than 10 words. All right. So prices going up is inflation. So we knew that already. Somebody else chime in. If prices going up is inflation, why are inflation worries causing the stock market to go down so aggressively today?
I think it's because since inflation is when the value of the dollar goes down.
Hold on, time
That
out.
means-
Wait. Start again, but don't say I think. When you say I think, it means that there's room for people to argue with you. Anytime you say something, don't say I think, because then it leaves room for people to think, well, he's thinking and it's not fact-based. He's not really defending it. It's probably just an opinion. So it's probably wrong. So never start with I think. Talk in matter-of-fact situations. Does that make sense, Adam?
Yeah.
All right, do it again.
All right. So inflation is when the value of the dollar decreases. So that means you can buy less for the same amount of money. So investors are trying to take out are trying to sell their stocks so they can take out their profits now while their profits would be worth more. Whereas in the future, the value of the dollar would decrease, which means they earn less.
Interesting. That is one argument they don't make on TV. Interesting. If you wanted your profit to spend it, you would want to get your profit now while inflation was lower. That's an interesting argument. I don't think that's going to drive the entire market this low, but it's definitely an interesting and valid perspective. And you mentioned inflation accurately and used it accurately here. What are some other reasons, and somebody else, why inflation worries are causing the entire globally? You know, Japan was down 2% overnight. China was down 4% overnight. The FTSE was down like 3%. And the US markets were down 2% earlier. Why was the market down due to inflation worries? If we throw out Adam's idea, and I'm asking for a new idea, give me another reason.
Inflation tends to be healthy for the economy, but right now, inflation, we aim for 2% inflation every year, but just in March, we had 0.6%. So that would mean that if we continue at that rate, we would be at 7.2% inflation for the entire year, which is just like way out of hand. So that can only lead to a crash. And so people are afraid that the reason that the market's rallying so much is due to inflation. So they're just pulling their money out.
Wait, why would the market crash?
Because when there's way too much inflation, that drives up the price of stocks and other assets. And that can't last forever because, you know, every large rally is also followed by a large crash when people start pulling their money. So people are afraid that this market rally hasn't been caused by the economy reopening or the economy strengthening, but just because we have huge inflation.
Okay. So you're saying that the actual rally was caused by the prediction of inflation, meaning that the prices of stocks even are going up due to inflation, and as a result, you may end up seeing a crash. Okay. Okay. What happens when you get too much inflation? What's the Fed's goal? Fed's goal is 2%. What happens if we get this 7% that you're talking about, Dimitri? If the Fed's goal is 2%,
yeah,
okay.
Prices for the everyday consumer would be like astronomical. Asset prices would rally. People wouldn't want to hold dollars. They would want to hold. They wouldn't want to keep their money in a savings account. They would want to buy hard assets, and it would just be a disaster.
Okay, but what does the Fed have to do? When prices get too high and inflation's too high, what does the Fed have to do? Someone else.
Increase interest rates.
Say it again.
Increase interest rates.
All right. Fed would increase interest rates. Okay. Making borrowing money more expensive, making growth more difficult. Okay, because you would end up seeing interest rates then going up on debt. So let's look at the most current inflation data. You said you found 0.6% in when?
In March, yeah.
In March, okay? Which we have to look at compared to 2020. Is that true? Or are we just looking at 0.6% between February and April?
I think it was just February and April.
Oh, somebody's got the horn honking. All right. So 0.6% February to April. That's a pretty big jump. 0.6% February to April. And if you keep on that trajectory, yeah, you would probably end up seeing plus 6% inflation, which would be kind of scary. The Fed said inflation was transitory. What does that mean? Look that phrase up. Transitory. That's the word he used. Inflation is quote unquote transitory.
Transitory means not permanent.
Okay, so what is he saying inflation is?
He's saying inflation will eventually go back down and not
That's
go
it.
up forever.
He said inflation is temporary, transitory. It's not gonna last. So yeah. Dimitri sees 0.6%. That's not gonna happen in July and August. Don't worry about it. That's his argument. So Dimitri's giving us 0.6 now, which leads to 7% later. Fed Powell said, you see 0.6 now, it's not going to be 0.6 for the rest of the year, and it's not going to increase at that rate for the rest of the year. So let's slow our horses a little bit. If that makes sense, put 100 in the chat. Cool. Okay. Let's move on to a little different topic, which we're getting closer today on, which is real versus nominal values. How does inflation impact your savings account? So I always like to, and it's difficult to talk money. Most people think talking money is a bad thing. I don't think it's a bad thing. I think it's something that's important. If anyone's comfortable sharing what they have in their savings account or what they have in a wide range of accounts, you can, and we can use that as an example, or you can just make up a number and let's use that as an example. All right, but can somebody give me either your real or made up savings account so we can use a more authentic number for question number 3? So for how inflation impacts your savings, between your savings accounts and checking accounts, who wants to give me a number of what they're worth or what they have in there?
Let's say I got $10,000 in my savings account.
Okay, let's say you got $10,000 in your savings account. $10,000. Well, if Dimitri's right, and we're going to have 7% inflation by December 2021, by December 2021, how much is that $10,000 going to be worth?
$9,300.
Okay. Now, how much is in your actual account? If nothing changes, how much would be in the account? Sean?
$10,000.
10,000. How much can that $10,000 purchase?
9,300.
9,300. If that makes sense, put 9,300 in the chat. If that makes sense. Good. So we're all on the same page that inflation devalues currency. We've discussed it before. Not too hard to go through it one more time. Great. Wonderful. Now we move towards question 4, right? If you earn 50,000 gross income, do you really earn 50,000 gross buying power? Casala. What you got?
I would say no. Because
Okay. You can't
uh,
just say no. You got to give me more.
because if you have inflation goes up, you would have less buying power because the 5,000 would turn into something lower.
Okay. So first and foremost, and we have to clarify this, inflation means going up. Deflation means going down. Right? Stagflation means sideways. So if you have inflation, it means prices go up even 0.000001%. Any increase is inflation. So saying that we have an increase in inflation is like a weird double negative oxymoron. I don't even know if that makes sense kind of thing to say. You would just say if we have inflation. Does that make sense, Casala?
Yes.
All right. So you wouldn't say, do we have an increase if we have an increase in inflation? Inflation already includes the idea of that's the increase. The term inflation is the increase. Deflation would be, so imagine you say we have an increase in deflation, right? That would sound weird also. Deflation means prices drop. Inflation means prices go up. So you don't have to put an adjective before it to describe it. If that makes sense, everyone just put inflation in the chat since that's what we have right now. Okay, so I don't need you guys to confuse that because then I understand why you would say it, just you need to be able to, it's like saying up and down. You wouldn't say if up goes up. Okay, cool. So, and you're correct. If you earn 50,000 gross, do you really have 50,000 gross buying power? That answer is going to be no. If there is inflation, you don't. If there's deflation, what do you have? If there's inflation, maybe that 50K buys $48,000 worth of goods. What if we have deflation?
You have more buying power with deflation.
Okay, which means what? What's that 50K buy?
More than 50K, like 52.
Oh, yeah. That's right. You get to buy more stuff, more coffee, more iPhones, more AirPods, more AirTags. I got these yesterday in the mail. I already put one on my keys. I'm going to attach one to my cat. I'm going to hide one in Laura's car so I can track my wife everywhere she goes. When the baby comes, I'm going to slip one on the baby's ankle so I can track the baby everywhere he goes. I can't wait. So here's my question. Why is the entire stock market down then? If inflation, like Dimitri said, implies a healthy economy because you only raise prices when consumers are willing to purchase. These cost me $100 for 4 of them. I would have probably paid $120 for these. So you can raise this price 20% and I probably still would have bought them. Who? Name some companies that have, it's called pricing power. Write that phrase down somewhere. What companies have pricing power? Those are the company stocks you should be buying when you have a sell-off like this. Because inflation, yes, it means interest rates are going up. It means that, expansion is going to be slower. Inflation does mean prices will increase. Maybe consumers buy less over time. But some companies have pricing power. Pricing power means you'll buy it no matter what. List me some stocks who have pricing power. That's where you need to invest your money because you're facing inflation. So there's 2 places to put your money. Stocks with pricing power and the companies that control the purchasing process because they issue debt when you buy online or in person. So let's go first. Who controls issuing debt? Which companies would you buy because people are making purchases?
Banks like Bank of America.
Bank of America, JP Morgan. They can charge more interest as interest rates go up, so they make more money. All right, easy, buy banks. Who else would you consider? I didn't go to the store to buy these. I bought these online, so I couldn't pay cash. How did I pay for this?
Online,
Visa.
Amazon.
Visa. Visa's another stock. MasterCard. I don't own MasterCard. I own Visa. But either way, they would both be beneficiaries because you'd be buying more, buying online. And since interest rates are going up, if banks can charge more, who can also charge more? Who can also charge more? If banks can charge more for loans, who can also charge more when you're purchasing products at the store?
Credit card
Credit
company.
card companies.
Perfect. Credit card companies. Everybody said it in unison. Credit card companies. Okay. Who else issues debt for credit? Square does it. PayPal does it. Visa does it. MasterCard does it. Amazon has a credit card with Visa. Apple has a credit card with Goldman Sachs. Right? So you have a handful of finance companies that will benefit greatly from inflation and from higher interest rates. Now let's look at businesses. If you were to buy a stock in a company, which companies have pricing power? Which means they can raise prices and you're still going to spend money at those places or on those services. Listed in the chat. Meldon, Apple. Okay. Meldon, what are you buying? What can increase in price and you'd still buy it?
AirPods. I feel like it's an essential whenever you get your phone.
Yeah, I mean,
any new phone that comes out.
Okay. AirPods, new phones, and AirPods. You're probably gonna still be willing to spend. Sean, NVIDIA, go ahead. You're gonna have to tell them what NVIDIA does, but go ahead.
NVIDIA makes graphics cards for computers. So
Okay.
people like you need a graphics card for your computer to run well. So they'll buy it no matter the cost.
Who will buy it?
People that are trying to build PCs or upgrade their PCs.
Okay. Who else buys NVIDIA chips?
I don't really know anyone else besides.
I mean, people don't buy them. They're not making money off 5 people buying their chips. Who buys NVIDIA chips?
Crypto miners.
Crypto miners. Who else buys those chips? Where do those chips exist?
Computer companies like Dell.
Thank
Intel.
you. Exactly. Right. Dell. I don't know if NVIDIA is in iPhones or Apple products. I don't know if they're in Android products or Samsung products, but it could be, even if prices of NVIDIA chips goes up, companies would pay for it because you need their chips if they're a leader in the industry. Who else? Meldon said Best Buy. Who else? What do you guys buy? What would you still buy no matter what? Why am I getting information from 3 people? Okay, Nike, Jeffrey, I got to hear about this Nike thing. I don't think I've bought new clothes since the pandemic started. I don't go anywhere. I don't even think I've put on a suit since it started. So I definitely haven't bought new shoes or a new suit. So is Nike, do you think Nike has pricing power where people are still going to buy at Nike as aggressively as they might have when they were out playing sports and going out? What do you think? Or do you think that now that the economy is reopening, they'll pay whatever the price is? What's your thesis on this?
I think they might pay whatever the price is only because Nike is has been around for so long. It's essential, and I think people would pay whatever price.
Okay.
Yeah.
Okay. So we'll throw Nike in there. Meldon said food. You got to be specific. You can't just say food. You have to be very specific. Is it which companies that make food? Is it the companies that produce chicken? Is it Purdue? Is it good? Procter and Gamble. Procter and Gamble's great. Can you tell me, Fan, what Procter and Gamble makes? Anybody know products that Procter and Gamble make?
They have a lot of household cleaning products and I think other beauty cosmetic stuff as well.
Exactly. And guess what? You're not going to stop washing your hair. You're not going to stop buying toilet paper. You're not going to start using toilet paper, then turn it over and use the other side. All right. You're not going to stop brushing your teeth. Okay. So those are definitely things. Muscani said Walmart. Can you talk to me about why Walmart? And now then we get to the Walmart Amazon argument, right? Now we get to the Walmart Amazon fight. But why Walmart? Why will Walmart be a beneficiary of higher prices?
Well, they're already known for being like a cost leader in the industry, and a lot of people have like brand loyalty to them. So I think that if the prices were to increase or they wanted to raise prices, they could do it in a manner that wouldn't be really like direct to consumers. It wouldn't be super obvious, and people would still go there because it's like it's known for being Walmart, and you still need household goods like food, and they have like everything instead of like a local supermarket, which might only give you certain things. Walmart, it has clothes, has food, it has, you know, beauty products. So people might be more tempted to go there and get their stuff.
100%. Walmart can raise prices 10 cents on everything. And the volume Walmart sells at, they'll make a whole lot more money. I'm trying to avoid Adam because he's talking about crypto. I don't know how crypto is a product that people use, but I'm willing to let you go and talk. Go ahead. How is crypto's not a company? So I'm wondering what your argument's going to be here.
Okay, so I thought this was like which stocks do we think still won't be affected by inflation? And I think it's crypto.
No. Not won't be affected. Stocks that have pricing power, which means even though there's inflation, they would probably do better with inflation. So Walmart would do better because prices are going up. P&G would do better because again, you're still going to buy toothpaste. But I'm willing to hear you out on this crypto thing. Why is inflation not going to impact crypto?
Okay, yeah, so I guess I misunderstood the question, but yeah, I don't think crypto is going to be affected by inflation because the cryptocurrency, what it's really about is like basically replacing the traditional US dollar. So like using a new digital currency. So I think like no matter what, people are still going to invest in it because they still believe it's like the future and it's its own currency that's not supported by gold.
Okay. I can see that argument that inflation would cause people not to worry about buying Bitcoin or any specific cryptocurrencies. That is still up in the air, right? If you would buy a cryptocurrency, there's a lot of people that still won't, but they'll still turn to the stock market. But if we revert back to these businesses with pricing power, can you guys think of anybody else that has pricing power? Does Starbucks or Dunkin' Donuts have pricing power? If donuts are $2 a donut, or your Starbucks coffee is like $5 instead of $4.50. If the salon that Dimitri gets his hair done charges an extra $5 for his wash and his cut. By the way, Dimitri, I go to a salon too. I don't go to a barber. These beautiful, beautiful locks cannot be touched by a barber. I have to be at a salon and need my hair washed. And if they charge me $5 more, they charge me $5 more. It's still going to happen, right? So Dimitri, you pay more at the salon or no? Or do you do your you say, hey, Dad, help me out?
It's a little bit more here. And yeah, for the salon, it costs a little bit more.
Okay. If you had inflation, would you still pay it? $5.
I probably, because yeah, it's a necessity.
So guys, it's not just products, it's services. So Muskan just said car companies. I'm going to jump over car companies and go to fixing your car. Are you going to do your own oil change? Probably not. Are you going to change your own brakes? Probably not. Are you going to replace your own windshield? Probably not. So who can charge more? Car companies or car shops. Okay. Sean said, if banks are supposed to benefit off of inflation, how come Bank of America and JP Morgan are down today? So thinking hats on for this one. If Bank of America and JP Morgan benefit from inflation and benefit from higher interest rates, why are the stocks down? Anyone have an idea? And then we're going to move on into a different topic. Why are they down? They should benefit, right? I mean, you have interest rates that are going to raise within the next 12 months. You have inflation, which means people are going to be, if they use credit, which are related to banks, they're going to be charged more, which means the banks makes more. So why the heck are they down today? Why are they red? Why aren't they green? Anyone have a thought? And I'm not going to bail you out. I need you guys to think about that one a little bit. Come on, think. Guys, you're boring me here. I'm getting bored. I haven't had enough coffee. Okay, if you have no idea why, just put a I have no idea and I'm not good at thinking in the chat. Just put I have no idea and I'm terrible at critical thinking. If you have any idea, just pitch it. Any concept.
So you said that when inflation happens, the Fed is forced to increase interest rates, but right now we're having inflation, but without the Fed increasing interest rates, and they're saying that they're not going to increase them. I think it was until 2023. So yeah, they're pretty much, the banks are only getting the worst end of the deal.
Yeah. So so this is the argument. The argument is Dimitri sees now. Dimitri, do you see 7% inflation in the United States this year?
I don't think so.
Okay. Do you think we see more than 2%? I do.
Definitely.
Okay. If we're already at 0.5%, there's no way around it. Airplane tickets are through the roof. You have a crisis in gas and oil companies because of the hack that happened over the weekend, where prices are already going to probably jump another 10 to 20%. You're going to see inflation. There's no way around it. I don't think it's transitory. I think the Fed's asleep at the wheel. I don't think that they're being honest with the people. So the reason banks would be down is the Fed is still saying they're not going to raise interest rates. So Sean, you have a fight here. The data says they should get ready to start raising interest rates. That's what the data says. The Fed is here saying we're still not going to do it. So banks go up, they come down, they go up, they come down, they go up, they come down. That's the first thing. Okay, is that there really is there's a consistent message from the Fed, but there's also pretty consistent inflation, right? But then you just had data last week where we made only 25% of the jobs that we thought we would make. Okay, here's why they're down today. Here's a chart of JP Morgan. Today it's down 1%. Can you guys all see that? JP Morgan's down 1%. Okay.
Yes.
Here's the past 6 months of JP Morgan. JP Morgan is up 40% in the past 6 months. In the past year, JP Morgan is up 80%. In the past 3 months, JP Morgan is up 15%. The stock market looks how far ahead? How far ahead does the stock market look into the future? Right? Stocks don't go up and down based off of what's happening today. They move based on what's going to happen down the road. How far down the road do they look?
2 quarters.
2 quarters. At least 2 quarters. All right, probably between 2 and 4 quarters. So I'd say closer to maybe 3, and then you give or take a quarter. So if we go 3 quarters from now, we're looking at Christmas. Okay, at Christmas, January, you're looking at the Fed still saying they're not raising interest rates, and the data still showing they should be raising interest rates. So 3 quarters ahead, you're predicting, hey, you know what? JP Morgan's going to have a good year next year. So it has gone up 15% in the past 3 months in anticipation of what's going to happen in 3 quarters. Does that make sense, Sean? So it's trading.
Yeah.
It's trading on the prediction of inflation and higher interest rates. That's why it has gone up 15% in the past 3 months. The problem that you see, though, is things can't go up forever. Well, what if they're wrong? What if you don't get enough inflation? What if inflation is transitory? So all you're probably seeing right now, I mean, the stock being down 1% means absolutely nothing, right? Apple's down over 1% today. So I wouldn't consider JP Morgan stock down today a big deal. Banks and all stocks go up and down daily for whatever reason. If you're looking long term, the reason JP Morgan is up for the past 3 months is because you predict inflation. The reason it's down today is just because everything is down today. You just sell everything. That's kind of where some investors are. If we look at Apple in the past 3 months, Apple is down 7% while JP Morgan's up. In the past 3 months, PayPal is down 18% while JP Morgan is up 15%. Right? So you see a situation sometimes where sometimes stocks just drop because the rest of the market's down. So that bodes the question, are banks a buying opportunity? Is a bank worth purchasing today? Because in the next 3 to 4 quarters, you see interest rates going up and them earning more revenue. Does that make sense, Sean?
Yeah. Okay.
So, all right. So you're looking at companies, you know, does Starbucks have pricing power? Talk to me about that. Do you guys think Starbucks has pricing power? Hello? Starbucks?
Yes.
Does someone-
Because yeah, already as is, people like some people think that the people that go to Starbucks don't go to Starbucks because of the price. They go there because of the experience. So if they're willing to pay $6 for a cup of coffee, which is a ripoff when you can make it at home for like 15 cents, they're going to be willing to pay $8.
Oh, but you're saying hi. Say hi. You say hi, everybody? No? Okay, you want to talk about inflation today? Okay. And that's 100%. They have pricing power. They have pricing power. And summer's coming. So you know, do you see Starbucks as a great buying opportunity? Possibly. Because you're going to see people out more. So it is an interesting day. At 9:30 a.m., maybe you had some better opportunities to buy some of these stocks. But maybe again, today was just a really bad day and you see a better day tomorrow, maybe you don't. But it is all related to inflation. The entire market down today is related to inflation. And I will say that. Questions, or we can move on. Okay. So what I want to talk today about is nominal versus real. So we talked about your $50,000 salary. That's your nominal salary, your nominal gross income, not adjusted for inflation. Your real salary takes into account inflation. Nominal values versus real values. If I told you that you get 1% on your savings account, okay, that's the number I give you. I'm telling you, you get 1% APY. That's annual percentage yield. We've discussed that. 1% yield on your savings account. What happens if we have 2.5% inflation this year? What is the real interest you get on your account?
Negative
Minus-
1.5%.
Go ahead, Rocky. What was that?
Negative 1.5%.
Negative 1.5%. You got 1%. That's nominal, right? The number you get, you're given. Then you have to take into account inflation yourself because nobody else does it for you. Then you look at the real interest rate, which has to take into account inflation. You got 1%. Minus 2.5%, you lost 1.5% in your savings account. You lose money. Nope. You lose value in your savings account every year there's inflation. You won't lose money because if you have 50 grand in the bank, you still have 50 grand in the bank. But that 50 grand no longer buys 50 grand worth. Okay, so let's do that. If you have 50 grand in your savings account, 1% interest, 2.5% inflation, what is the buying power of that 50 grand, right? You still have 50 grand money-wise. What's the buying power of it?
49,250.
Okay, 49,250. I didn't do the math. I assume you guys are good at numbers. 49,250. So you lost 1.5%, which equates to $750. You lost $750 of buying power. There's still $50,000 there, but it's not earning anything. It's losing value. This is why I find inflation interesting. Why the hell would you keep money in a bank account earning 1% when some stocks can give you 2% or 5% in a year or 10% in a year? That's why I find the stock market down always interesting to me. Because how much can someone keep in their savings account losing value without thinking, I should just throw this into XYZ company, which is a strong business, and then you sell it after it makes more than 5% or 3%. Now, what is the risk? What is the risk in taking it out of your savings account and putting it into the stock market?
You risk the possibility of losing on your money.
Yes, you lose even more. So I'm not telling you to throw it into some stupid stock. I'm thinking of you to throw it into a blue chip leader in their industries, right? If you do that, or an index fund, and hopefully you beat what inflation is. So I think that democratizing finance and everyone having access on all these other platforms now will inevitably cause the markets to continue to increase in value and continue to go up. Because as people learn more about inflation and hopefully learn more about their savings accounts, the faster you have access to your money, the more likely you might be to invest and hopefully beat inflation, right? I have like $65,000 in my savings account right now. I'm losing value on it every single day. I'm looking at one stock to throw it into for the next few months. Once I get a return higher than inflation, plus the tax I'll have to pay, I'll sell it and I'll put it back in my account to be safe. Sean, your hand.
Oh, yeah. So you said like, why would people take their money out of the stocks, like if they'll make more money? But didn't you say that like these big companies, like investment bankers that have like the hundreds of millions and billions of dollars, like they really control the price and the volume?
Mhm.
So like, wouldn't they be moving their money in like not regular consumers? Like, wouldn't that be affecting the price more?
Yeah, so the bankers are definitely the ones, and the hedge funds are definitely the ones that move the stocks. Correct. But the thing is, as a person with a savings account, if you have enough people that start investing, it ends up being one big hedge fund. Robinhood is really one huge hedge fund if you think about it, with all these people putting more money into it. It's just an interesting thing to think about. All right. Matt, I don't believe in the market makers theory. We'll have to have a separate conversation on that. But I do want to go down to these terms that nominal and values exist in. Yield is a huge value that you guys have to consider. It's one that we've discussed, and it has a nominal and a real value. Okay, so yield, definitely nominal and real value. That's APY. APR, annual percentage rate, your interest rate that you pay on debt. You have a nominal and a real rate that you pay, because you have to take into account inflation. Income, you have your nominal income, that's what your salary is. Then you have your real income, which is after inflation, how much can you really purchase? Right? You don't really earn 50 grand a year. You earn 50 grand a year minus inflation, you earn 50, but it can't buy $50,000 worth because inflation is a moving target. And then prices, you have real and nominal prices. Nominal is the number where they are now. Real is adjusted for inflation, comparing it to a previous year. So prices of your iPhone last year versus this year. Prices of this water bottle 2 years ago versus this year to see if there is inflation or not. Easiest way to consider calculating it, take the real interest rate, subtract the actual rate of inflation from the nominal interest rate, and you get the real interest rate. So to get your real interest rate, which we just did, it's simple subtraction. If you're talking current today. If you want to compare to previous years, you can compare 2005 to 2021. You can compare 2009's crash to 2020. So you can compare inflation 2009 to inflation 2020 and see what happened with prices. Okay. That would be called a base year, where you go back to a specific year to look at their values to compare inflation today. That's called a base year. The rest of these terms you should already know. Federal funds rate, interest rates, real and nominal we just talked about. Current prices are current prices. And the GDP deflator is related to the base year and when you're calculating for GDP. We're not going to do that today. All right. But just know the base year and you guys should be fine. The base year is the year you're using to compare inflation to when looking backwards. So if it's 2021 right now, and we want to compare inflation to the first year of the recovery after the market crash of 07, 08, 09, we'd probably use 2009 as the first year of recovery. Therefore, if we're comparing inflation from 09 and 2021, what would be our base year that we're using?
09.
09. It's very simple. It's very simple. I'm not trying to trick you guys. It's stupid to even ask the question. It's so simple. But 2009. If I wanted to just look back into last year, what's the base year?
2020.
2020. I don't like using last year because of COVID. COVID was a freak incident, right? The economy shut down. Never happened before. Global economy, global trade, things were, everything was shut down. Jobs were lost at a scale maybe you've never seen that quickly, right? As a result, I don't like comparing this year's inflation to last year because last year was a freak accident. I would look at the year before that. So if I'm comparing 2021 inflation and I want to compare for productivity, efficiency, and prices, I'd look at what year if I'm not looking at last year. What base year would I look at?
2019.
2019. Yeah, Eric. Simple. 2019. Rocky, your hands up.
I have a question. So let's just say the economy crashes like again. Would you go back to like, would your base, like if you want to compare, would it be better to compare it to the previous year before the crash or the previous crash?
It as an economist or as just a nerd, it would depend on what you want to compare. I could see comparing prices in 08, 09 to prices in 2019, 2020, or 2020, 2021. 08, you had the real big crash. 09, you probably started the recovery. In this case, 2020, you had the crash. 2021, you had the recovery. So if you compare those 2 years with these 2 years, maybe we can see a trend. Then what you do is, let's say we have another crash in 7 years. Well, then we compare 2027, which is the crash, and 2028. So now we look at 3 different events. 08, 09 with 2020 and 2021 with 2026, 2027. That would be what somebody would probably do if they want to analyze GDP or inflation or, and I say productivity and efficiency because we're going to get to how those relate. But if you wanted to really check for real and nominal and you wanted to see and compare GDP and growth across a series of events, or price changes across a certain time period, you could look at after the year after every single recession, which you're looking at, 09, 2021. If you go back before that, you might be looking at 2000. And then before that, you're looking at like 1987. Then you compare all of those years and you see a pattern, and you can see if a pattern exists. Okay. Sean, hand.
Yeah, so like when we were talking about base year, I remember that we use the base year in the CPI. So when you're calculating the CPI, do you still use the nominal or do you use the real value?
No, if you are comparing, you're using the nominal to find the real. Right? If you're comparing last year's CPI to this year's CPI, you're using nominal numbers to find the real number. Okay? You use the nominal numbers to find the real numbers. I gave you the very, very basic, simple today version. If you're just comparing nominal and real values today for your own account on current inflation. If you really want to compare years, you have to use a base year, and then you would be using nominal values. Okay, so I want to go down to these questions, and I want to give you time to answer them. There's 3, 6, there's 8 questions that I want to get to. I'll give you till 1 o'clock, and then we'll discuss them at 1 o'clock. Add these to the Google Doc that you just created, and that'll be what you have to submit today for classwork. So use the same doc you did with the first 4 questions of the do now, add these questions to it. You could probably just copy paste this from the Google Classroom for the real versus nominal and just input the real values, or don't copy and just put the real numbers in there yourself in your Google Doc. All right, but I do want to go over it, so I'll give you guys till 1 o'clock. If you're done early, just put done in the chat so I can see a number, because if you're done in 10 minutes, then we can finish early and we can go through it faster. All right, so I'll let you guys do this. I'm going to mute and drop your name in the chat when you're done. Remember, if you're done, throw your name in the chat. All right, 2 more minutes, guys. Good. What number you guys on? What number you guys on? Real quick. Okay, good. Let's start going over this. Okay, first person that was done, Dimitri, read the whole thing with your answers.
A bank loans a person $400,000 to purchase a house at an interest rate of 3%. The nominal interest rate, not factoring in inflation. Assuming the inflation rate is 2%, as a result of this information, the real interest rate the borrower is paying is 1%. The real interest rate the bank is receiving is 1%. That means the purchasing power of the bank only increases by 1%, but the number everyone sees is 3%.
Perfect. Go ahead.
Do you want the first one?
What was that?
You just want me to do the first one?
No, nope, you're good. That was perfect. 1%, 1%, 1%, 3%. Who's got a different answer? And then we'll go over how you got there and what to do next. You all got 1%, 1%, 1%, 3%. I find that hard to believe.
I got, as a result of this, I put the real interest rate the borrower is paying is 5%. I didn't put 1%.
How'd you get 5%?
Because it said the borrower is paying 5%. I just added the bank's interest rate and then the
So the real interest rate the borrower is paying. So what does the interest rate you're paying? What is the nominal interest rate you're paying as the borrower, Sean?
3%.
3%. If you're paying 3% and inflation is 2%, what part of that 3% is inflation? Do you understand what I'm saying? So if you're supposed to be paying 3% interest, but inflation is 2%, how much of the 3% that you're paying is inflation?
Only 1%.
No, what's the inflation rate?
My computer is lagging. You cut off.
If you pay 3% interest on a loan,
Yeah.
and the inflation rate is 2%, how much of the 3% of the interest rate is inflation?
2%.
2%, which means how much of the amount you're paying is actually interest?
1%.
Because 1 + 2 = 3. So your nominal number is 3% interest, but at 2% inflation, you're really only paying 1% interest, because out of the interest you're paying, 1% is really interest, 2% is actually what inflation is. So the bank, you're paying 3% nominal. You're only paying 1% real interest. The other 2% that you're paying is actually from inflation. Then you're looking at the real interest rate the bank is receiving. Yes, the bank is receiving 3% nominal. However, after you take into account inflation, the bank is only receiving 1% extra in interest. So the real interest rate they're getting is only 1%, which means their purchasing power doesn't go up by 3%. It only goes up by 1%, because they're only earning 1%, because the other 2% they earn is really what?
It's inflation.
Exactly. So the number everyone sees is 3%. Oh my God, look, banks are making 3%. Wrong. In a 2% inflation economy, a 3% loan, they're making 1%. This is why, as inflation comes, interest rates change, because banks need to earn more because they're earning less as there's inflation. Which could be why your JP Morgan's down today. Because if you're seeing inflation and you're not seeing a higher interest rate and a higher federal funds rate, banks are going to earn less money until interest rates go up.
That makes sense.
Any questions on question 1? That was a pretty good dialogue. Any questions on question 1? Good. Number 2, super easy. Steven, go. Short term.
That's the only one I didn't do.
All right, Eric, number 2.
Short-term nominal interest rates are set by central banks.
There you go. And the biggest central bank in the United States is the only central bank, the Fed.
Feds.
Yeah, the Fed, not the feds. The feds are the cops, right? The feds is like the FBI. The Fed is the Federal Reserve. So short-term nominal rates are set by the Fed. Set by the Fed. Stephen, why don't you do number 3 then? Salvage yourself.
So I wrote low nominal rates encourage consumers to take on more debt and increase their spending.
Yes, 100%. Low nominal rates take on more debt, increase spending. Notice now we're not talking about interest rates. We're talking about nominal interest rates. Because now that you guys know inflation and how to account for it, you can't just say interest rates because they're different than what they actually are. Good. Who else was done early? Vivian, can you do personally?
Personally, if you borrow $100 at a 6% interest rate, you can expect to pay $6 of interest. Is this nominal or real? This is nominal?
This is not, are you asking me or telling me?
No, I'm telling you.
This is nominal, correct, because there's no mention of inflation. You have to be mentioning inflation for it to be real. So if I were to tell you 6% interest, you have to assume everything you're hearing is nominal. Okay? The next thing, if you guys have to go to a bank for your student loans, ask them if this is my real rate or is it my nominal rate. And most of them will probably like, first of all, they probably really won't understand what you're talking about. But then they'll probably be like, let me get back to you. And then see if you have some ability to negotiate. All right. Next question. Vivian did that. We did Vivian. Rocky, did you go yet? No. Rocky, what's the disadvantage? Go.
Wait, I need to find the question. The disadvantage, what is the disadvantage of using the nominal interest rate and only thinking of the nominal interest rate? If the nominal interest rate is only 1 to 4% and inflation tops that percentage, your real interest rate is in negative, which means you are losing purchasing power when it looks like you are earning money.
Good. So it's confusion, right? It messes you up because you think you're making money when you're really losing money, or you're making money but you're losing buying power, right? So that you have to know that there's a difference. Making money and losing buying power, that's an inverse relationship. So if you really want to screw with your friends, ask them how you can make money and lose buying power at the same time, or how you can make money but be able to buy less at the same time. And they're going to be like, you can't do that, it's not possible. And then bet them like $20 and then teach them about inflation and then take their $20 on top of that. And then you can teach them 2 lessons. All right. Stephen, Eric, Muskan, can you do in a savings account?
Yeah, I got the real APY is -1 and your nominal APY is 0.5.
Yes, your real APY is -1 because it's 1.5% inflation with a 0.5 APY. Simple subtraction. 0.5 minus 1.5 equals -1. You're losing 1%. Your real return is negative. Sucks, obviously. Your nominal, which looks good on paper, is 0.5. Oh yeah, I'm making 0.5 on my money. Psych, we have inflation. You're losing money on your money. All right. This is kind of depressing, isn't it? Jeffrey, in 2020, which I made up, by the way. Don't you know?
In 2020, real GDP grew 1% with an inflation rate of 0.5%. In 2021, nominal GDP is expected to grow at 7% with a projected inflation rate of 1.75%. What is the real GDP? 5.25%.
Good. 5.25%. Perfect. And Stephen gave you the head nod of confirmation. That's what Stephen got also. So yeah, so 5.25%. You're growing at 7%, but you're not really growing at 7% because you're not taking into a cost rising prices. GDP is the cost of goods sold, right? Goods and services sold in the country. That's your GDP, gross domestic product. The problem is that that cost includes price increases. So you don't really know. Let me ask you guys a question. If Starbucks sells 100 million cups of coffee at $1, and next year they sell 100 million coffees at $1.50, did they have growth?
Of course.
What?
Of course, yeah, they did.
What if I told you that? Well, I'd like you to tell me why you consider that growth.
I mean, like, let's say we dismiss inflation for now for the sake of the argument, but like if they raise their prices, obviously they're gonna make more per the amount that they sell. So if they're still selling the same amount, but they're just earning more per item that they sell, then obviously they're increasing their profits or revenue.
Okay. They're increasing their revenue, yes.
Yeah.
Is the company growing?
I don't know if I don't think the company is growing. I think they're just earning more revenue.
They're definitely earning more revenue, but is the company growing? Can they hire more people? Can they open more stores? I'm still with you.
I'm not sure. I'm not sure.
Well, why not? Take a guess.
Okay, I'm gonna guess yes. I'm gonna guess yes, but it's a tough one because I don't know if 50 cents is really enough.
Well, what would you, what would you guys consider growth for Starbucks? Making more money or selling more cups of coffee?
Selling more cups of coffee and opening up new stores.
And opening new stores. You don't open new stores unless you're selling more cups of coffee. Okay. So if you were to tell me you're selling 1 million cups of coffee at $1.50, or you're selling 5 million cups of coffee at $1, which one is growth of the business?
The more cups sold.
Exactly. More cups sold. So this is where you have the real versus nominal GDP argument. The second to last question is trying to ask you, do we really have 7% GDP growth if prices are 1.75% of that, right? So if you counted Starbucks in GDP and Starbucks isn't selling more coffee, they're just raising prices, is that growth? Put yes or no in the chat. Is that national growth? Okay, most of you guys look like you're typing no. That's hopefully what I was trying to steer you to, because the next question is important. Which value measures productivity and efficiency, real or nominal? Write in the chat, real or nominal. Which measures productivity, efficiency, which measures real growth of a business? Brandon Chang, why don't you talk to me about that?
Well, real value measures like how, like the actual, how the numbers change compared to previous time. So that shows how much you actually have, like today, how much you can produce and how efficient you are with the resources you have.
Perfect, perfect. So that's between real and nominal in terms of efficiency and productivity. Nominal doesn't take into account inflation. We discussed that, which means nominal counts price raises as growth, which isn't necessarily growth. Adam said it great, growth in revenue. Is it growth in the business? Is the business growing? Did Apple sell more AirPods? No. Did they raise their prices? Yes. Does it look good for Apple that they sold the same amount and were able to raise their prices? Yes. But is it corporate growth? It's not. It's stagnant. There's no new buyers there. There's no new production. There's no new efficiency in the business, right? So which actually measures productivity and efficiency would be real, not nominal. Are there any questions on that while we have 2 minutes left before we go? Great discussion, but is any of this confusing to anyone? Come on, guys. You're learning real versus nominal the first time. You have no questions. I'm that good, or you're that smart, or all of us are stupid. I don't know which one it is. Either we're all dumb or we're all really, really, really smart. Emmanuel, haven't heard from you all day. Matt, haven't heard your voice all day. You guys have no questions on this?
Oh, I have a question. Like, so like I'm confused on how to like find the real like interest rate.
Okay.
Like, I feel like that confuses me the most.
Okay, how to find the real interest rate that you're paying or receiving.
That you're paying.
The real interest rate you pay. Okay, so if you're paying, let's say, so my mortgage is 2.375%. That's my mortgage right now, every year. It's 2.35%. Let's even use a big number. Most credit cards are 17%. The average credit card is actually, I think, around 20% right now. Is average credit card APR, which is your rate you pay. Okay? That's the rate you pay over the course of the year. If you divide the 20% APR, let's not even divide it. So let's say 20% per year you're paying, okay? So how do we find out the real interest rate that you pay? This is the nominal amount, correct? It's the number you're given, the number you're initially given. 20% APR, your credit card rate for the year. Not every month, but for the year. Now, what that means is if we have 3% inflation, okay, what are you paying for your APR for the year?
17%.
So this is where the confusion comes, okay? You're still paying 20% APR. However, 17% of that is real interest and 3% is actually from inflation. That's where you're probably getting confused. You still pay 20%. You still pay 20%. But then you just do the math. How does your bill break down? Well, when you look at your bill, it's actually 17% of this is real interest, and the other 3%, it's still you still have to pay it, right? You still see the number, which is 20%. But when you look at what Visa gets, if it's 20% APR, they get the 20%. But of the 20%, since there's 3% inflation, they're getting 17%, which is real interest, real 17% purchasing power, right? Real 17% dollar worth. The other 3% is just what covers the cost of inflation that year. So Emmanuel, you would still be paying 20% on your credit card, but what Visa gets from you, only 17% of it would actually count as benefit of interest, like purchasing power they can use. The other 3% is really inflation to cover normal costs that have gone up due to inflation. Did I confuse you more?
No, so basically, let's say that inflation is like 6% then.
Okay.
Right. So I'll still pay 20.
Correct.
But then they'll get like but then they'll pay like 14.
Well, they'll still get 20%, but how much of that benefits? And I know if you guys have class, you can go. The Visa will still get 20%. But if there's 6% inflation, how much of that 20% actually benefits Visa?
14%.
14
benefits them.
14 benefits them because the other 6 is just to cover other inflation costs, which could be rent, it could be food, it could be taxes, it can be salaries. The other 6% just covers normal inflationary costs. Electricity bills, all that stuff. So you still pay 20%, but Visa would see the other side where they're only earning really 14% of real extra income. The other 6% goes to pay other expenses because there's such high inflation.
Got it.
Okay. Anybody else?
I have a question.
What's up?
Does the 3% goes to the government, or it's just doesn't exist?
No, the inflation, it exists. It's like this, Eric. You owe me $100, right? Plus 10% interest. So you owe me $110. I still get my $110 from you. The problem is there's 2% inflation. So you gave me 110. You gave me an extra $10 for the loan. But out of the $10 you gave me, how much of that is real profit for me? Because there's
Minus 2%.
Minus 2%. So of the 10, let's do 20% inflation for this argument. You gave me $10. How much of the $10 is really profit for me?
Minus the 20%.
Exactly, which is how much? Come on, what's 20% of 100 of $10? $2.
Oh, 0.8.
80% of $10 is $8. Okay, so you gave me 110, which means you really gave me an extra 10. 8 of that 10 is profit for me. The other $2, which is 20%, it looks like profit, but those $2 go towards inflation, which are costs of everything else going up in my life. So I only really benefit by $8. The other $2 really just cover extra costs that I face every day in my life because of inflation. Matt made an interesting message in the chat. It's like gross versus net income. Gross is what you think you get. Net is what you get after taxes. Nominal is what you think you get. Real is what you get after you have to put money aside for inflation. So take a look at this. This is what you get, okay? As a bank or Visa. This is what Visa gets from you in interest. Then this is inflation. So they really get this whole thing. However, this is extra income they earn. This looks like extra income, but it's not. This goes over here because it pays for inflationary costs. Together, it looks like I made a lot of money. However, after looking at inflation, right, this is nominal. This is really what I have because this is what covers inflation costs. Rocky, you laughing at my diagram or are you talking to somebody else? Eric, does that make sense?
Yeah.
Okay, cool. Other questions and I'll let you guys go. And I appreciate you staying and asking questions. I want to make sure you guys understand this. You guys are good?
I have a question.
What's up, Alex?
It's like the second to last question is about the GDP rate. How did you get the 5.25? Because I still don't understand that.
Okay, good. So let's math this out together. I added the first sentence just to mess with you. So ignore the first sentence. I did that to do it on purpose, right? That's just extra information about 2020, but we're really focusing on 2021 for this immediate diagram and discussion. So 2021, we expect to grow at 7%, right? That's GDP growth 7%, correct?
Yes.
Good. However, grow at 7% GDP. Now you have to remember GDP includes costs, which is inflation. Okay, so we expect to grow at 7%. However, the economy has 1.75% inflation. So did we really grow at 7%? Because 1.75% of that growth is just prices are going up. Prices aren't GDP growth, right? Prices make it look like we grew more than we did. Going back to the Starbucks example. If you sell 1 million cups of coffee at $1 or 1 million cups of coffee at $5, you didn't sell any more coffee. So if we expect the economy to grow at 7%, but we have inflation of 1.75%, you would subtract the inflation from the actual growth. And we really grew GDP at 5.25%. Because remember, we're removing inflation because we're not counting inflation as real growth for the United States. Because all that is more prices. It's not more productivity. It's not more creating products. So you have to remove the cost of higher prices. So we grew at 7% nominally. However, we really grew at 5.25 because we had to remove the prices, which make it look like we grew more than we did.
Okay, thank you.
Does that make sense?
Yeah.
All right. Do you want to go through a different scenario? So let me ask you a question. If we have nominal GDP of 5% and inflation of 2%, all right. So I'll do the math. I'll do it right here. GDP 2021 ends up being 5%. Okay. And let's do this. And then we had real GDP 2021 of 3.2%. What was inflation? So nominal GDP is 5. Nominal GDP is 5%. Real GDP is 3.2%. Alex, what was inflation during 2021?
$1.8.
That's it. You got it. 1.8%. You got it. Does that make any sense?
Yes.
You're good?
Yeah, I just got confused because I didn't know that you just had to subtract it.
If we were comparing year to year, we would have to do the base year, and then there's a huge equation. To simplify, at least for now, until next week, to simplify, to get you guys understanding nominal versus real, we're just going to subtract inflation. Like we would do in your savings account or earning income if you were a bank. If we were comparing, hey, I want to compare growth in 2018 versus 2021. Well, now we have to use a base year, and there's a huge mathematical equation that I have to teach you guys. I just need you to understand that as of right now, nominal is the number you're given. Then you remove inflation, and then you have your real number that you have, which the real value is.
Okay, thank you.
All right, good enough. Rocky, you staying here just because I look pretty, or you got a question?
Oh no, I was just staying here to like listen to the rest of the lesson.
Does
And
that make sense?
your hair looks really nice. Yeah, yeah, it makes sense.
I'm trying. The hair looks good, right? Curly.
Yeah, it's just like it's curly, it's wavy. Have a nice day.
We'll see you on Friday.
See you on Friday.